Welcome to the webinar, Managing Cash Flow Like a Fortune 500 Company at a Fraction of the Cost. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, and then we'll dig into our presentation. First, we'd like to thank Centime for their partnership with today's event. They've been wonderful thought leadership partners for Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Centime. We appreciate you joining us today. We welcome you to stay connected during today's event. For those of you who are active tweeters, please follow us on Twitter at Argyle Exec Forum. I also wanted to take a minute to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. For those of you who are seeking CPE credit today, you must answer at least 3 polling questions and remain on the session for its duration. Polls can be found under the Polls tab on the right-hand side of your screen, and right next to chat, and there will be a new poll about every 15 minutes. Afterwards, if you're eligible to receive credit, you'll receive an email with a link to your certificates. If you have any questions about credits, please email cpe@argyleforum.com. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Before we start our discussion, we'll have our speakers introduce themselves, and then they'll begin their conversation. David, since you're our moderator today, let's start with you, please.
Thanks, Eric. Yeah, so I'm the Chief Accounting Officer for Vonage, a technology company. Prior to that, I was with Bristol Myers Squibb and close to 30 years of experience, both in small companies and large, and public accounting transactional activities as well. So a very significant career of managing technical activities, but cash management has always been a part of that, of all of those activities.
I'll go next. George Day. Currently I'm the senior program manager within Amazon. My experience is pretty deep and wide. I've spent over 20 years as an entrepreneur myself, wearing many hats, including the CFO hat in my organizations. I've also done extensive work consulting with small business, and appreciate the forum to discuss cash flow because it is super important. I would even say more so with small business, and that's been the perspective that I hope to bring today. Thank you.
Great. Sergio, let's continue with you, and then we'll have Saurabh introduce himself, and then we'll begin our conversation with David.
Perfect. Hi, everybody. My name is Sergio Giannos. I'm the Chief Product Officer at Centime. Centime is a company that helps small and mid-sized organizations control and manage cash flow. I personally have been in the space for the last 12 years across banking and financial technology, and across payments, cash flow, and other adjacent areas. And very excited to be in this group, very excited to talk about cash flow, the lifeblood of the enterprise, and very excited to hear very diverse opinions from people with clearly a lot of experience and a lot of different experience. Thank you very much.
Thank you. And Saurabh, let's conclude with you, please.
Right. Hi, everyone. My name is Saurabh Jain. I work for Siemens, over 20 years of audit, consulting, and corporate controlling. Cash is something which is very close to my heart. It's something that we spend considerable amount of time and energy managing and forecasting. So I'm really glad that I can share some of my insights with this faculty and the fraternity. So thank you, everyone.
Thank you.
Great, thank you. David, over to you.
Yeah, thanks, Eric, and thanks everyone for introducing yourselves. Obviously, there's a very significant level of experience in just managing business, not just cash flow, but just being able to sustain an operation and ensuring that cash continues to be part of the reason why you're successful. Cash flow is one of those areas that just doesn't have its foundation in structural control. So if you think about it, you've got a general ledger that manages your financial reporting. You've got tax filing requirements. You've got all kinds of compliance activities and all kinds of areas that establish controls for standard and, quite frankly, very highly disciplined reporting. Cash flow is one of those areas that is obviously couldn't be more important, but doesn't have the structural components of compliance that all of the other sort of areas in finance would have. And it runs across the entire organization in terms of your ability to be able to manage it. So from collections from customers, payments to vendors, managing the level of debt, managing your ability to forecast and being able to know how much money you need. And then in the event of a transaction, if you want to acquire a company, or if you need to make a major investment in a particular technology, all of these things become very difficult if you don't have your hands around your cash flow and your cash positions and your availability to cash. So engaging with banks, engaging with investment vehicles, and ensuring that you have the access that is necessary. So how do we do that? How do you go through that process? And I've seen it done well, and I've seen it done not so well. And where it's not so well, companies struggle to grow and to invest in areas where they need to. So I think we'll start with just the basics of just managing inflows of cash first, and thinking about customers and billing and how money comes in. And depending on your industry, depending on how large your portfolio of customers are, it makes it difficult, or can make it difficult, to track, manage, collect, and ultimately ensure that the money is coming in at the time you need it to come in. Tracking customers and collections are very difficult. Why don't we start with George? I'd love to hear your thoughts around, given your entrepreneurial experience, getting money in the door. Vendors always want to be paid. If they don't, they'll cut you off. Customers tend to want to extend, and they want to take time and ask you for more time. As an entrepreneur, and then onto your even larger responsibilities at bigger companies. What are your thoughts around just generally managing customer receipts and inflows of cash?
Yeah, I think probably the biggest thing I could say about this, coming from small business from consulting small businesses, is really being realistic. To your point, David, your terms, that you offer aren't how you get paid, and I think understanding that net 30 or net 15, or even someone taking a discount but paying you really after terms, is the old checks in the mail kind of thing is it really does matter. So I think one of the very first things is being realistic, both with your sales team and your collections. And in a small business, you might be responsible for all of that. I also think transparency is really important with vendors and customers. I think one of the things that I always did, I was a part owner of a manufacturing company. We were very transparent with our customers about how we price and how we work with them on pricing our product. And we used to tell them all the time, we price based on how much you're going to buy from us, how much time do you need to pay us, and how are you going to then how are you going to pay us? Is it going to be an ACH? Is it going to be a credit card? All these things go into pricing, and it allows us to price appropriately. And then on the vendor side, I think it's important to be super transparent with your vendors. In many cases, I don't think it matters small or large business. Many of us have a very maybe an 80-20 rule. We get a lot of our raw materials or other services from 20% of our vendors. And if you run into an issue where you're not transparent with those vendors, you can run into an issue where, in this day and age, when everybody knows about supply chain disruptions, it's just super important to be transparent.
Yeah, thank you, George, for that perspective. So, Rob, I want to tap into, as controllers, we tend to be in the middle of it all. All of the issues that ultimately result in an ability to generate successful, profitable businesses. The controllers tend to be in the middle of it all. We get we never seem to get the the attaboys, but we always get the how come the vendor wasn't paid on time, and how come I have to take such a big reserve on my receivable portfolios. Just in general, as a controller, what have you experienced in terms of being able to really support the organization at the same time, sort of fend off the why aren't you doing better?
Yeah, it's a very interesting question. I mean, sometimes the controller is in the middle, and sometimes the controller is on the driver's seat, and I've had both the positions in the past. So one interesting anecdote, and that would put a lot of perspective, is that during the Great Recession, especially when we had large amount of volumes with the Southeastern Europe countries, which were affectionately called pigs at that time, Portugal, Italy, Greece, and Spain, and a huge amount of receivables. And I can tell you the DSO, days, number of days of sales outstanding, was over 400 days in our line of business when the terms were N30 or N45. And I work for a healthcare business in a large, conglomerate, and we had principally governments that were our customers, and they would just not pay. And putting things like customer blockage or pricing, because this was all done with tenders, was just not possible. So it was the most complex thing that required a strategic management of our markets, pricing, and a mechanics to resolve how to be collected. So just as an example of how you look at managing cash flow on one side, but also managing the process. And we invested heavily into managing these 4 or 5 geographies, starting with setting up dispute resolution cells, because the idea was the cleaner your receivables were, you could take them straight to the factoring companies and get a discounted ones. The moment those got bad, the documentation was bad, the amount you could recover from factoring was considerably weak. So very interesting times. We had to have our inventories managed at the best level, and receivable collection, especially with the documentation, sign-offs, approvals, number of days they were outstanding, the dunning process, how many letters were sent out, how much time of the reconciliation with the customer has happened, how many escalations happened, and all of that documentation in a plan that you could actually sell it out to a factoring company. And then the amount of the factoring cost had to be pushed back to the customer. So that had to be a complete cycle. It's a very interesting experience. But yeah, I don't want to look back and see the kind of experiences we generated. But I also learned to never say never. So keeping my fingers crossed. But very interesting thing. Cash was very important.
So Rob, thank you. And you bring up an interesting point around factoring. You know, I was going to bring up, you know, what do we do? How do we get cash? How do we manage relationships with banking institutions? It's not just about borrowing. It's not just about getting a revolver or financing a particular event. In a lot of industries, it's about factoring. It's about whether or not I can take my receivable portfolio and go to a bank and say, hey, I'm willing to give you the responsibility for collection, and I'm willing to pay you whatever the rate is. And the rates are actually very, very different depending on the risk of the country, the risk of the area, the risk of your portfolio. But it's all about how much you can substantiate and how good your evidence is that collectability is ensured. So if your invoicing process, if your dispute resolution process is very strong, you can go to a bank and tend to get a better rate than if you're really unsure about your collection ability, and ultimately the country that you're dealing with is a high risk country. So it varies greatly, and we've all experienced the issues in Asia, and it didn't matter what industry I've been in, whether it was distribution, whether it was pharma, whether it was biotech, or even technology. When we're dealing with Asian countries and companies and customers, that 45-day receivable can easily turn into sometimes 9 months, if not longer, if you don't stay on top of it. And some of them really they make an art out of delaying your cash flow, and that could actually impair your ability to grow and your ability to invest and your ability to actually be successful and profitable. So really good point there, Sarab, on factoring. It becomes a way. Sometimes the rates are a bit higher, but it becomes a way to get cash very quickly, as opposed to waiting for a revolver or having to extend that revolver as you grow. Thank you for that. Sergio, I wanted to tap into your experience, as it relates to systems and as it relates to managing process. Just focused a little bit just on the collection side first, and we'll talk about projections in a bit and how we manage cash flow overall. But just the ability to have awareness and just generally being able to manage the cash flow what are your thoughts around the automation and process?
Yeah, thanks, David. I think I want to make a couple of points because I am really fascinated from the discussion happening and how I hear terms which are very strict processes, people thrown in the matter, expertise, experience, access to capital through banks, through factoring, things which clearly when you are in a larger organization, these things seem natural to go to those measures and establish processes, throw people at the problem, and really put your arms around this in order to drive faster collections or solve the collections problem. But now I want to portray the picture of a smaller business, of a business that has 50, 100 invoices sent out every month. The $2 million, the $3 million, the $5 million company, the $10 million company that not only doesn't have a process, but doesn't even have the awareness that after they make a sale and they establish a net 30 without even assessing the credit risk of the company that they're offering the net 30 to, they might not get paid. And what we know for a fact is, after speaking to hundreds of business owners who go in for the passion of building a business, not for managing, we know that these businesses don't even have dedicated staff doing this. They don't have any process. We know that many businesses don't even realize that they need to call or reach out after 90 days of the receivable being aged. So what is extremely important is to communicate the huge difference between the big business, which has these processes, the awareness, the tools, the expertise to manage this problem, and then the smaller business that doesn't do anything about it. But in reality, it is not difficult to establish a process around collections, even if you're a smaller business, as long as, one, you have the awareness that this is a problem, and number two, you have some technology to help you. What are the important components of managing collections in a smaller business? One is creating visibility. I think you mentioned it, David. It's creating the transparency, the visibility of what is my aging? Who is likely to pay me late? If you look at a typical aging portfolio, you can very easily identify people who are likely to pay you late. How? By analyzing data, historical payment behavior. The people who always pay you late will continue paying you late. So identifying those and predicting those late payments is very easy if you use technology and you try to figure this out. The second thing, which is extremely important in the collections process, is frequent and open communication with customers. Again, you mentioned this, David, in the beginning. So by using technology, businesses can basically communicate with their customers continuously. Not wait 90 days after the invoice is due, but send them proactive nudges before the due date, after the due date, and also give them ways to pay. It is very important to provide options to your customers. They can pay you by ACH, they can pay you by credit card, but give them options. And what we feel is it's very important to make these electronic payments. So the creating visibility through technology, through predicting invoice payments, invoice delays, payment delays, connecting that into a continuous nudging of customers to remind them about open invoices before and after the due date, and offering payment options is a very simple process that can be facilitated without having even one collections person in the team, only through technology. And it is proven that by keeping better communication with customers and by offering payment options, this can drive faster payments for small businesses. So I wanted to make sure that I do, recognizing all the things that are set up in bigger businesses, we do, comment on the fact that smaller businesses don't have any of these things, but hopefully technology can help them become getting there, and also make sure that this process is systematically established and scaled as businesses grow. Because we speak to clients who, for example, have 100% year-on-year growth, and that means that they're doubling and tripling the number of customers and the number of invoices. So there's two ways to solve this problem. One is to throw people at the problem, another is to use people, but also use technology.
Yeah, thank you, Sergio. And I would say, to your point around smaller companies, having been at big and small companies, and today I'm actually at what I'll call a medium-sized company. So Vonage is $1 billion in revenue. So somewhere in the middle, I started out with a company called Danskin, where we had 100 million in revenue and less. So I've kind of seen all three areas, and I have to say, even with the best of disciplines, even with the best of systems, and even with the best of people calling and collecting with dunning letters going out, collections is always hard. It's just always hard. And, customers will take every advantage and every opportunity to delay payment that they can. And so if you're not on top making phone calls, it's really, really hard to manage that intake of cash. So thank you for that, Sergey. I agree. Automation and systems are a key part of the collection process. As you're making phone calls, as you're trying to understand what the reasons for delay are, you need a system where you can actually put notes in so everybody can see it. If somebody's out, somebody can pick up a particular portfolio or a particular company or customer so that you can see what happened and where they were. It needs to be up to date. If you're talking to a customer and you're looking at a screen and the screen is not up to date with a payment that was just made yesterday or a credit that was provided today, you're going to be behind the eight ball, and you're not going to be able to engage really strategically and effectively with the customer. So systems are the only way you can even have a chance, quite frankly, of managing it well.
Yeah, this is a very important point you're making, David, if I may intervene. Very simple example. I very rarely speak to companies, even the very, very small companies that sell to other businesses and don't use some sort of CRM for their sales process. HubSpot, Salesforce, and very, very high percentage of smaller companies will use some sort of CRM. And the moment that the sale goes through and the contract gets signed, it then drops into an abyss of Excel and email and some papers and some invoices under a drawer. So why this huge distinction between I'm using systems to drive sales and growth, but when it comes to collecting the cash I sold, I'm relying on Excel and paper and all these very opaque processes. I think it's a huge
Sergio, I want to be clear. You're absolutely right. And it doesn't matter if you're at a large company or a small company. This back office operation is always going to be the second-class citizen of operations. And I don't know what it is. It's directly customer-facing. It's directly impactful to your ability to grow. And yet, order to cash, quote to cash. And I shouldn't say quote to cash, because you're right. The quoting process through the CRMs usually are a high focus. But, record to cash, everything that happens, after the order is in, seems to always be a second-class citizen that doesn't get the light of day, and it tends to fall. One of the areas that I want to just focus on here, just for a little bit longer, to keep the order to cash process going here, is disputes. What you tend to find, in a lot of times when you're collecting and trying to bring cash in and finding out why collections aren't what you expected them to be, what you're discovering is service delivery issues, potentially customers that weren't happy with what was originally sold, and so the contract wasn't what they expected it to be. The delivery wasn't what was expected to occur. So dispute management becomes a very big part of cash management. And if you don't have people on top of not only just making phone calls and trying to get cash, but also finding out why they didn't get the cash, and also what was the dispute. So you have a customer service operation here that needs to be hand in hand with the collectors. And so just collectively, I'll leave it to all three of you to chime in terms of your experiences with dispute management. But how have you seen companies do well and maybe not so well? George, you want to, or Sergio, either way, go ahead.
I would. The only thing I would add to that is that anything that is disputed, if you don't know and you haven't recorded it, you wouldn't understand the impact on cash flow. And the reality is that, collecting and having clarity around when you can collect and when the money will come in is about connecting that back to cash flow, availability of cash, and ability to meet liabilities, or having to rely on credit or other means. So disputes is another component for me, which is very important to be managed in a systematic way, so that you have this clarity that you should not be planning your cash based on that receivable until that dispute gets resolved. Disputes, promise to pay, estimated days, predicted days, all of that, the importance of all of those components for me are in order to be able to understand the impact on cash flow and connecting the dots.
I've seen the larger companies, Amazon more specifically, but most of the big box companies have done a really good job. If you receive a product that you don't like for any reason, the return process really has been very strong. And as a result, I think they actually generate more sales. People are not as apprehensive as they used to be to order online because they know they can return. George, your thoughts on that?
I'm thinking about things that we used to talk about when we were consulting with small businesses. And one of the things that we always talked about is, it's interesting, and I see this conversation, I would say it's about, CFO level stuff, or cash flow isn't just a finance. It's not just siloed in finance, because you can see how this reflects on the entire organization. If you're in manufacturing, your production team, getting to root cause, was there something we had a problem in production? Is it sales? Is it setting realistic expectations for the customer? Is it customer service? Is it following up to ensure that everything worked well? Sometimes it's everything's great with the product, excuse me, but maybe the delivery was late. Excuse me. So there are multiple issues, and it's important to get to the root cause of the issues you have, because obviously in any business, you don't want to have to keep reinventing the wheel for your sales. You go through this massive effort to bring in a sale, to bring in a relationship, and then you need to maintain that, obviously, to cut, it just drives up your cost of sales dramatically to always be spinning your wheels, getting new customers. So, and in a world where social media is so prevalent, the word gets out too. So people know whether or not they can trust you, whether your product works, whether or not your service is valuable. So I think it's very important to realize that everyone in the company should, be focused on this topic. We tend to talk too much about P&L and other things like that, and the revenue, but revenue is a promise, right? In many cases, it's not an instantaneous thing unless you're in a cash business transacting something, point of sale. A sale is great, but you still have to collect the money. And that's why it's important that everybody's involved in the conversation and the process.
Yeah. And Sergio, you mentioned aging, and I think Saurabh did as well. Looking at aging every month, looking at DSO every month. But honestly, I look at aging every day. I look at our aging every day. I look to see what cash has come in. And I'm not in treasury. I don't manage treasury, but I have to manage the impacts of cash management. And ultimately, we're looking at the portfolio risk at the end of every day. And we look to, much like an investment firm would, and looking at their net portfolio risk at the end of every day, we look at our AR portfolio at the end of every day to see where things are. So absolutely. So I want to change gears a little bit and just go and, we talked a little bit about vendor management, but I think, equally, it's important not only to manage cash flow in, it's just as important to manage cash flow out. And you'll see in this discussion how, again, as George said, the impacts of cash management are global and really impact the entire organization, and the ability to manage cash flow really comes down to discipline everywhere, and not just about cash collection, and not just about your ability to have an awareness of how much money is coming in, but also about managing your vendors. Do you have a procurement process? Are you requiring purchase orders? Is there disciplined buying? Is there a budget process that requires a certain approval level at certain operations? Do you require RFPs with vendors? Are you managing your vendors, and are you negotiating pricing? Are you consolidating to give yourselves more leverage? There's a lot that goes into whether or not we're paying vendors the right price. And then are we even managing the right vendors? Are we engaging in a way that we're assessing whether or not the vendors that we're engaged with are the ones that we should be? So cash out is just as important as it is as cash in. And there are opportunities for ensuring discipline and management as well. So I'd like to start with Saurabh in terms of, from a controllership perspective. There are certain controls that we require. Some of them, because from a financial perspective, you're required to. Sometimes they're operationally important, and a lot of times they're important just to ensure the success of the business. Your thoughts around vendor management overall as it relates to cash flow?
Yeah, I mean, I think, David, vendor management has multiple facets, and of late, the right equilibrium between cost, efficiency, and management have gone a little bit haywire, in my opinion. But let me say, at Siemens, we manage the entire supply chain, which means we develop our top tier 1 and top tier 2 vendors, which is like investing with them, developing the processes, developing the quality consciousness. We are pretty big on ESG right now, so their platform and the continuity with that, audits, all of that. But what's very important is, from a controller's perspective, is what we define it as productivity. Huge amount of volume-based rebates when those rebates kick in. We also have to manage the supply chain payments. Otherwise, we really don't want to be put on blocked orders. So some of the processes that come along with managing large-scale vendors is a huge amount of automation and backward integration. So most of our suppliers are now working with EDPs. So they're connected with our systems. They generate their purchase orders, which go through our own automated systems, and we approve. And that kicks in the volume-based discounts and rebates. However, we start calculating the rebates based on volume. They start calculating or giving out rebates based on collections. And there's a huge gap there. Second thing is, where I was talking about processes and efficiencies, we've consolidated and outsourced entire AP to our shared services. And as a personal business owner or a business line finance head, I find it as a nightmare, because what happens is, although the processes are now optimized, the cost of running it has gone down, the control and transparency have diminished. So you realize that while you have reports after reports, one snag and the customer, the vendor is not getting paid, or the automation is stuck somewhere. So a lot of that process needs to be invested on, besides managing the workflow. So the right equilibrium between systems and outsourcing and focusing on the most the volume-driven rebates stays critical to our business, and forecasting all of that. I think that's the most critical part of the AP side of the cash flow.
Thanks, Saurabh. And you bring up outsourcing, and I have also some extensive experience in outsourcing. And AP is always the first place you go to try to reduce cost and operation. And I've had good experiences and some not so good experiences. And most recently, I've done outsourcing to a particular organization that has actually done quite well, and we pay a little bit more for it in Europe as opposed to going to Asia. But you get what you pay for, and so if you want somebody to just duplicate a process every day, all the time, and that's all they're going to do, you pay for that. But if you want somebody to engage with vendors and understand what their responsibilities are in terms of ensuring proper payment and proper payment timing and the controls associated with it, you'll pay a little bit more for it. But it will be advantageous to ensure that those controls are in place, because if you miss a vendor payment and they cut you off, it shuts down your operation. So just to keep this discussion moving, George, I'd like to get your perspective on, smaller companies, where you've had that experience. where maybe the discipline wasn't there and the systems weren't necessarily ready to go. Some of the pitfalls and maybe something you can offer in terms of advice around how to manage it.
Yeah, I think I love the conversation that's flowing around partnering with your vendors and investing in your vendors. What you have a unique advantage. There's a lot of maybe, let's say, disadvantages of being a small business owner in this world where you're maybe competing with big companies. But the one thing you can do is have that relationship with your vendor, develop that relationship with a vendor. And I think I said this before, but it's worth repeating, being transparent and honest with your vendors and really getting to understand, why is it that they need something done a certain way. I've had experiences where people have said to me, look, I don't mind if you pay me in 60 days, but at 61 days, I lose my credit insurance on you. And so I need you to make sure you keep me at 60. I need an ACH or a wire transfer at 60 days. So there's things, if you can understand the why behind things, sometimes it helps you. And if you can stay within that, and maintain the integrity of that relationship, but just being transparent. Everybody goes through well, I shouldn't say everybody. A lot of people have seasonality in their business. A lot of people have, periods of time where they're going through growth. That sounds great, but growth is usually done at the expense of cash flow in many cases. So it's important, I think, to just be very transparent with those vendors and make sure that they understand where you're coming from. If you're looking to build a long-term business, it's very important that you maintain strong relationships with vendors.
Yeah, thanks, George. In Sergio, I want to get your perspective on this, but as we think about some systems that are out there, I mean, I've got an Oracle system, I've been in SAP, and I've been with the larger systems, and no matter where I've been, we've always had a fairly significant ERP, but I've never had to manage a business on QuickBooks. I've never had to manage a system that was, they call them fully integrated because they have AR, AP, they have everything all inclusive. And some of the smaller companies, that's what they use. They're using Peachtree, they're using QuickBooks, so they're using those kinds of things that have it all in there, and they have functionality for POs and all of that. What are your thoughts around the big disparity between a full ERP and some of the smaller systems? Are you seeing that the smaller systems are kind of evolving to be even more beneficial to some of the smaller companies, or are you seeing that gap continuing to grow?
Yes, very good question, David. I would say, I want to answer your question with a couple of different angles. One is that certainly the gap, I feel, is continuing to grow because at the end of the day, a general ledger is a general ledger. A general ledger is designed to be the financial source of truth for the business, to be the place where you do all your reactive bookkeeping, your reconciliation, your compliance, your tax, and so on and so forth. These systems are not designed to be everything. They're not designed to be proactive places where you can manage your AP, manage your AR, or manage cash flow, like some of the larger systems are that you are referring to. And even there are gaps. That's why there is adjacent markets and technology providers that provide such services in a dedicated fashion. But let me take a step back, because again, it's fascinating to hear how the big business perspective and how outsourcing and process and vendor negotiation, procurement in smaller businesses, you know very well, right? Having been there, none of this exists. There's no procurement, there's no POs, you receive an invoice, you put in a drawer, you get it out of the drawer, you sign a check, you send the check in the mailbox, and that's about it, right? That is the process. However, I think the very important realization that businesses need to make, the smaller business need to make, is that actually AP is a great strategic tool to manage working capital. And I'm not saying delay payments. I'm not saying float checks in order to delay payments. I'm saying that if you really are strategic around how you manage your open invoices, how you look at what is due to be paid, when is it due to be paid, how is the relation with the vendor, what are the payment options available to pay a vendor? Can I pay by credit card? Can I pay by ACH? Do I need to pay by check? And then be able to connect the dots between payables and cash flow and the impact of making vendor payments to your cash flow. That's where you can really start thinking about pushing DPOs and still keeping your vendors happy. And the reality is that whilst smaller businesses are in desperate need to manage cash flow day to day, they do not have the sophistication or the tools to be able to connect the payment process, the vendor payment process, to the cash flow management process. These are still managed as two independent activities, as two independent processes. You have an AP person who will go and send checks and don't really care about the cash flow of the business. And only if the CFO or the acting CFO, the business owner, realizes that actually, hang on, we have payroll to run on Friday, and you're saying we should pay this vendor, hold on, don't send out this check because we're going to be in a problem if this gets cast out. Only in that ad hoc way, the connection between payables and cash flow happens. So in essence, what I am saying is that it is very important to make sure that we think about the cash flow management process and the payment process as one comprehensive whole, as two completely tied, integrated areas of a financial process for smaller businesses, in order to then elevate AP as a strategic function for managing working capital, even in smaller businesses. And that's where technology has a great role to play in that space. I don't know what your opinion is about.
Yeah, Sergio, you're preaching to the choir. I think everybody sees that as the concern. And I actually want to move on to forecasting cash flow, but just staying on AP just for a minute and managing vendors. I think even at the smaller companies, and I remember in my early days in public accounting where, you walk into little companies where you're the controller essentially, and you're seeing, invoices pile up on the secretary's desk that weren't getting paid. And, then at the end of the month, somebody kind of looks at that package and writes manual checks on them. Hopefully those days are gone, but, I think there's some element of that still inherent in smaller companies. You've got to log those invoices as they come in. I don't care if you put it in Excel. You got to put them in QuickBooks. You can't just leave them there because they'll get lost or they just won't get managed. So there has to be some level. Again, even in Excel, it's better than just letting them pile up. So there's Excel, there's QuickBooks, there's Peachtree, and then there's ERPs, SAP and Oracle. So there's a broad range of technologies, and some of them, quite frankly, very affordable. And if you think you can manage your business without having something to manage that volume, you're mistaken. You will be in trouble, and those vendors will cut you off. So yes, I do think that it's really important for automation, and it could be at any level. Manual processing of vendor activities is not an option for any company at any level. So let's move on to forecasting. I think, and this is another area that we've talked about this sort of high level at this point, but, the ability to manage cash flow is only as good as your ability to project it. And projecting cash flow is, and I started off this conversation by saying this whole area is not something that is so a well-disciplined sort of ERP function. You do have cash management systems, and it takes years to get all of the pieces to be able to work in an automated way. And again, even in my company, and we're a sizable company, it is still a largely manual process. So in the treasury area, I have a team that some of them go and work with the collectors, some of them go and work with the AP team, some of them go and work with the payroll team, some of them go and work with the engineering team to see what's happening there. So it's a very manual process, even at its best. And I want to get the perspective of the really large companies, because I can think about my time at Bristol Myers Squibb, where I honestly didn't think it was much better than that. The Treasury Department always has a very difficult time piecing it all together, and it ultimately ends up in some report. It could be Excel, it could be something automated, but it's not an easy process. But the more you work on it, when I first got where I am, they didn't even do it at all. They didn't even try to forecast it. And it was bad for the first year. It took a long time to get it right, but you got to work at it. You got to keep going at it. And eventually you'll figure out that if you find the right people and find the right areas and try to get at, well, historically, what have our vendor payments been? Historically, what have our cash receipts have been? What's our payroll been? Where is it paid? And you start to get a feel for where the cash flow organizational process is happening. So I really want to get George's perspective first, and get a sense for because you've got that small to large perspective as well. And then I'd love to hear more from Saurabh in terms of a control perspective. And then Sergio, we'll talk a little bit more about automation. But let me know what you've seen. Again, even at a highly disciplined public SEC SOX-ready company, it's largely manual. The entire cash management projection process is, and we have cash management systems, and it still ends up in Excel at the end of the day. George, your thoughts?
I think from I agree, David. I think the interesting thing about a lot of the tools we've been talking about is there's a balance sheet, a snapshot in time. Projections are looking at, a P&L is a result of looking at the past. Anything you do with projections, budgeting projections, is inherently flawed for a number of reasons. In small business, sometimes it's lack of diversity of opinion. You have limited people involved. Sometimes it's you might have a subject matter expert who, think about the tech world, a subject matter expert who's really good at what they know, but then they're forced to wear the CFO hat. Maybe a VC is forcing them to go through exercises, and so they lack the ability to really think through, like, are these projections even believable? And I think there's this kind of theory of, like, if you got projections and they're based on false assumptions, meaning they're based on, hey, we say our terms are net 30 or net 60 or whatever. We've talked about that earlier. Or I'm going to pay my vendors on time. And if you're using the incorrect inputs, your projections are going to be way off, and the value diminishes greatly. So it's just, I think there's inherently in small business, we're dealt with the hand of having, I guess it was being resource constrained in so many ways. Obviously, money being one of those. But I think understanding that, if you can get it right, and if you can get this information in, and if you can find a way to automate it and move away from some of the, like I would call siloed, these whole ideas of, the Excel spreadsheets. I mean, guilty as charged. I mean, that's always the way that we ended up doing it. And I would say, to bring this kind of maybe full circle, and last comment I'll make is, a lot of these off-the-shelf products are meant to be generalist type products. They're not meant to focus on some of these things like budgeting and projections. And in particular, I see deficiency in cash flow. So you're sort of forced to take information you have, information you're collecting, historical data, and then push it into a siloed tool where you don't get the benefit of seeing everything together. So I think, projections are important, but it's really important that the data you're using for those is good data.
Yeah, thanks, George. It's a struggle. It's a struggle, and I'm seeing some questions come through from the audience. Everybody is wrestling with this, and again, even in the best of situations, and I know it's not best practice to think about it this way, but sometimes having a manual process where you're capturing the data from the different automation areas, cash flow in, cash flow out, payroll, I've seen it as quite frankly being the best. Sergey, maybe you want to just provide your perspective on, have you seen any better automation approaches?
Yeah, I mean, you made some very good points, right? One is the importance of having gathering. So what is cash flow forecasting? It is gathering data, analyzing data, so that you don't only take what you gather, but you put some intelligence over it and make sure that it's accurate, and then placing that into a forecast so that you know where you're going to go over the next 6, 13, 26 weeks, whatever that might be, right? We know that a golden standard is the 13-week forecast for every CFO. So this process of gathering, analyzing data and placing them into the forecast, and then making sure that this forecast is up to date, is something that, as you very rightly mentioned, most of businesses that do have the awareness of the importance of doing that, they do it in a manual way. They do it by getting people to speak to other people, to gather the data, to put them in Excel, to clean them up, and then to put them into a forecast. However, if you think about it, all those data points, typically in smaller businesses, sit within a QuickBooks, a general ledger. They are somewhere. They are either AP or AR, or they are historical payments made to suppliers, to payroll, to rent, to other non-invoice based payments. So in essence, what our premise is that a cash flow forecast can be to a great degree automated with the use of technology. Using the current AP, the current AR, and being able to also understand previous payment behavior of customers to predict payment dates from an AR standpoint creates a baseline. Overlaying to that baseline historical payments, payroll, all these other non-invoiced expenses, and using machine learning to predict those payments creates another layer. So now you have all your AP, your AR, and your predictions in one place. So now what our premise is that every small business, by pushing data into certain applications like Centime, can create and continuously manage an automated and rolling cash flow forecast. Because the other thing is that those smaller businesses are much simpler as well compared to large organizations. The cash flows are simpler. They're still a lot, but they're simpler. Therefore, technology can come in and create a foundation which can then act as the place where the person who is managing this day-to-day can build on, and that creates a continuous rolling cash flow forecast that can then be used as a compass for AP and AR. So technology can play a significant role in automating the cash flow creating process to a degree, of course, because always there needs to be a human element, because at the end of the day, technology does not know everything.
Yeah, that's go ahead, sorry.
No, but yeah, but there is a fundamental thing that we are missing here, and is the quality of the forecast. Yeah, it's the entire P&L. So if you really think of any business, big businesses are still prone and insured by their inputs from their central nostro accounts or treasury, but a smaller business cannot afford it. So let's say you need to pay salaries, your owner needs to buy something, big capital expenditure, you have a limit to your revolver, all of that is your constraint, and you really need to depend on predicting cash flow. And there you need to predict your revenue, you need to predict your collectability, you need to predict how much would be locked in inventories, you would need to predict how much would be required to pay out on an urgent basis and deferred. And that requires two things: sound quality of what you have as data inputs, and a very thorough understanding of each of these inputs. So somebody who sits in a room and is going to predict how much I'll collect, and I think we alluded onto these topics, but all of this information means historical information plus your intelligence and your ears and eyes close to the ground. Because if your quality of forecast is bad, what you decide will be nonsense, absolutely nonsense, because you will be short. You would not know that your inventories have gone up by 100 million or whatever amount, a million, where you weren't expecting that. And that's the most critical thing. How close are you monitoring the situation?
I think all three of you said the same thing, and I think I think all four of us actually did. And I think what's going to be a surprise here is no matter how much you automate, no matter how much data you can provide, and how much data you can get at and analyze, at the end of the day, there's no replacement for actually doing the analysis yourself and putting it all together. And the problem with it is it's going to lack integrity and initially. And that's what I want to be clear. I said when every place I've ever started doing that, it was wrong for the first several months. And it takes you a while to find all the pieces. A question's coming through from the audience around, what was our biggest mistake and, how did we fix it? I mean, to me, the biggest mistake I've seen in not only where I am now, but really in any place, is assuming that cash in was going to be consistent. So there's always blips, there's always indications of problems, but you can't always predict customers paying you late. And so just overall, I just want to be clear about the key element of everything we just said is historical information. And plugging that in to set your base. It's no different than creating a budget. When you create your P&L budget, you look at history and then you model what you can, and you use automation to the extent you can get the data. But ultimately, your historical base has to be set, and the historical base needs to have integrity. That's something you can ensure. Is all the cash in, all the cash out is real. That you understand it, where it's coming from, and the predictability of it has a lot to do with the integrity and how you break it down. But the biggest mistake I've seen cash management make is that your cash flow in was going to be consistent. So if you've had growth and you've had a surge in cash collections. Then all of a sudden, the next 2 or 3 months, it goes back the other way, and you find yourself short of cash. The biggest concern I would have is anybody who's thinking that any surge in collections or any consistent growth in collections will be maintained. So in any event, I think it's important that that you think about the geopolitical, the local customer issues happening that will impact your inability to continue that consistent cash flow in the door. So I think we're running up against time here. There's a couple minutes left. I'm going to hand it back to Eric to see if there's anything at the end. I think we've answered a few questions that have come through. Eric, back to you. Let us know kind of where we are.
Great, thank you. Unless there's no other questions from the audience, we're going to wrap up. We're bumping up against time, and we'll wrap up for the day. Thank you, panelists, for an amazing presentation, and thank you, everyone in the audience, for joining us today for this really excellent webinar. Thanks again, and enjoy the rest of your day.